Welcome, 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 everyone. We are so excited for you to join us, and we've got all the coaches here tonight. And so we are excited about today's topic. But if you could just put in the chat where you are watching from, that would be outstanding. And tonight we are going to be talking about, is this a good time to buy real estate? You know, you can watch the media, guys, can't you? And watch the news, and it's usually death, doom, and gloom. And look what the real estate is just going to crash. You know, they like using words crash, and they like using words, this is the worst time. And so I would just like to, first of all, introduce my great friends. First of all, they're coaches, but they are great friends. Troy, how in the world are you, brother?
Mike, I am doing wonderful, my friend, and you are so right. Today's people just never want to waste a good crisis, do they?
That's so true. And Mr. Frank Pulley from Denver.
All right. Thanks for joining us tonight. You know, a lot of times by the time you hear stuff in the through the media, it's already happened. I mean, it's old news, isn't it, Troy?
Oh, yeah, it is.
Yeah. So we hope to help you keep your ear in the ground and what things to use in order to do that, to be a step ahead of other investors.
Yes. And then, of course, you know, when they see an increase in real estate, they're the first ones, you know, to jump on the bandwagon and say, oh, yeah, the real estate's doing really good after the fact, you know?
Yeah.
Well, good deal. Well, we have a couple of people signing on here. We have Sherry, and she doesn't say where you're from, but we're glad for you to be here, Sherry. Sadrine, I hope I'm saying your name, from North Carolina. We're glad to have you guys. And I tell you what, this is just a good time to be educated. You know, Billy says that you need to have knowledge, and you need to have time, and you need to have money as far as investing goes. And so this is part of getting the knowledge, guys. And so Wealth Builders, I mean, it's just a phenomenal family atmosphere that wants you to know, that teaches you that you can have knowledge, and then that because of the teaching, guys, you will be able to make the money, and you can put time into this. Amen.
Amen.
Amen, brother.
All
Just
right.
like Sherry's from Lebanon, Tennessee, and we got a bunch of other people out there that are being quiet. They're not chiming in.
All right. Well, so Karen, are you ready to pull up the PowerPoint this evening? And we can get started if you are ready, young lady.
Yes, absolutely. And so tonight we are going to be talking about, is this the right time to buy real estate? And so we've got a pretty, I would say, like comprehensive, maybe is the word, presentation tonight to kind of give us an idea of the market. And overall, the answer to that question is yes, it is a great time to buy. And that's something we want to share with you, but we're going to give you several market updates as we go. It's going to be a team approach here. And so I'm going to go ahead and bring up that PowerPoint and we will get started. All right, so here we go. The presentation is titled, Is This a Good Time to Buy Real Estate? And so I've just got this little subline there that says how faith, data, and stewardship create generational impact. All right, so tonight, this is what we're going to be covering. First of all, we want to welcome you for being a part of this. We want to let you know that the real estate market has shifted, but it has not crashed, okay? And I know that we've got a government shutdown. We'll be talking about that. It's kind of some interesting things happening. We're going to unpack what's really happening, where the opportunities are, and there are opportunities, and how to make wise buying decisions. We're going to learn to read the data, thanks to the other coaches, and apply strategy for 2025 and beyond. And our goal tonight is to help equip you to invest with confidence, timing, and wisdom. All right, so here's an agenda. We're going to go through the market overview. We're going to go over mortgage rate trends, which there's some good news in that area. Home prices, looking at them historically, inventory and rent trends, the real estate cycle, Is it a good time to buy? We'll give you some more information on that with the answer, financing strategies, creative deal structures, some calls to action to help you get activated, and then we're going to have some Q&A. All right, so these guys are like totally like I get to call on them and they may not know that I'm calling on them, which is fun for me. And so guys, I would just really love to be able to call on you guys to share some of this information. And so this first one, Mike, if you wouldn't mind covering this slide, that would be great.
All right. The market has normalized after record highs and rapid corrections. And so the 30-year fixed mortgage rate is averaging around 6.3% for Freddie Mac in October 2025. And so, boy, this is really up to date, guys. I'm telling you.
It is.
The home price is up 1.5 to 3% year over year in most regions. That's the Case-Shiller Index report. The inventory rising across major metros. It's up 12% year over year. That's realtor.com. And I see that even in Pueblo. And I'm sure your guys in your markets, you're seeing an increase in inventory. And but the rent growth is steady at 2.3% year over year. And so we've got some great graphs. I love that graph that's in here about the rent. That is amazing. Yeah. And so the investor takeaway is this: we're entering a more balanced market with less competition and more negotiation power. And so that is tremendous. That's a great combination, is it not, Karen?
It is. It's great. And you know, so much, we always like remind you that real estate is a local market. It's, you know, we have national trends that we share, but real estate is local. But I think that we could say overall, definitely things were a little bit slower, but this is a time that's an opportunity for us as investors to step in and get some good deals. All right, so this one is home prices over time, and this is the Case-Shiller Index, and we always have our go-to Troy to take us through some of these graphs. So Troy, tell us what we're looking at here.
Yeah, graphs just kind of tell the story, Karen. You look at a graph and you go, uh-huh, I get it now. And one thing this graph shows us is the general increase in value, the general upward incline in values that we've got in homes. You see a couple of anomalies, like we can see the Great Recession there by that big wide gray bar there in the middle of your screen. That's what happened to home prices in 2008. But I want you to notice that even when they fell to the lowest between 2010 and 2012, they were still higher than they were in the previous recession of the 2000s. So even when a correction happens, housing still holds some value. And since then, you can see what's happened on the increase. It's just gone up and up and up. And even today, where it's kind of stabilized out, we still do have a price increase, as Mike was talking about on the previous graph. Now, it's important to understand that real estate market moves a little bit slowly. You've heard it say that the stock market can move in a day, but real estate market moves in a year. It's a very slow market. And but with the trend that it continues, when you look at it over time, you can see why we really like real estate, because even through the worst of times, it still has an upward trajectory in value, which just kind of increases your wealth. I look at real estate and compare it to gold. They're both hard assets. They both go up in value in the right economic situations. But real estate actually, I think, is a little better than gold in some ways, because real estate generates income even in the slowest of markets. People still pay for a place to live. So when you look at a graph like this and you can see the upward trend, and then you mix it with also the income potential from that real estate, you can see why we really like real estate.
Yeah, that's so good. And Troy, one of the things I was just noticing is I've shared, but I was like in banking during this time. So I felt the pain of what was going on here. But here, you know, these are dips that are little in comparison. They might feel big to us, but these are very little in comparison. And the overall trajectory is just really important to notice. And here's some just overall statistics. Home values are up 5 times since 1987, despite the recessions. Also, the average annual growth is between 5 and 6%, And just the statement that recovery always follows correction. And so I was just wondering, maybe Frank, you could comment on that. What do we mean by recovery? And are we in a correction?
Well, yeah, I believe we're in a correction right now, but it's not a big dip as we talked about before. So I would anticipate a recovery. Now, the recovery doesn't mean it's going to happen tomorrow. Real estate runs in 7 to 10 year cycles, so it may be a while, but if you buy right, and in our coaching program we show you exactly how to calculate these numbers. So if you buy right and the market dips a little bit, it's not a big deal. Part of the problem has been the last, I don't know, 10 or 12 years is we haven't had a lot of inventory, and that has driven the prices up. Now, that previous slide a couple slides ago shows that any inventory is increasing, so that is a good thing because that might help stabilize the prices.
That's super helpful. Thank you so much. All right. So here, just talking about mortgage rates, the rates have actually declined from 2023. They were around 7.4%, and we're talking about the conventional loan rates. And now they're about 6.3% today. A matter of fact, and we'll talk more about this, but I was visiting with a DSCR lender, and some of the DSCR rates are in the mid to maybe upper sixes, which is like a big improvement. I was just looking at one of our properties that we refied about a year and a half ago, maybe 2 years, and it was at 8.8%. So if we see a 2% dip, there's some opportunities in that, which we've talked about all along. If you get in at a higher rate, you cash flow, and then the opportunity comes to refi, that's a huge opportunity. The monthly affordability is improving slowly. And we've got a chart that we're going to show you about affordability, and it really is something that is connected to the median income. And we'll show you some statistics going way back to where we are today. Refinancing activity is definitely increasing among investors. If you don't know what a DSCR loan is, I really encourage you to come to the real estate workshop. We're going to talk about it. They're a really wonderful tool for us as real estate investors. It's a product that is now being really accepted quite wide. This is something that it's not a conventional product, but it is a standard product for investors.
Yeah.
The Fed is signaling gradual easing into 2026. I was just reading some articles, and Powell has gone out and kind of just like greased the skids, you might say, and let people know that he is going to be reducing rates. Most people are expecting 0.25%. And while those aren't directly related to mortgage interest rates, they definitely have a relationship with that. And then buyers are adjusting to the new normal of 6 to 7%. And those of us that have been around a while, we know that that's actually an average interest rate. When we're in like the 2 to 3%, those were anomalies. I don't know that we'll ever see that again. So we really are getting into a normal interest rate environment. And here's just a little tip for you. Don't wait for perfect rates. Buy what cash flows now and refinance later. And Mike, maybe you want to talk a little bit about what we go through with our coaching clients that helps them to really analyze things no matter what the interest rate environment is.
Yes, we have a great chart, an Excel worksheet that they can just plug the numbers in. I mean, it's not rocket scientists. You just put in there what the house, the value that you're going to pay for it. You put in the down payment, and man, it will cause you to be able to know if it's going to cash flow, it's going to give you a return on your investment. And so there's tools like that that we have in coaching that can help somebody, and it takes the fear factor out. It really does. And so that's the main thing. I think when you gain knowledge and having the right tools, and when you get a property, you say, this seems like a good deal. Well, all the coaches will do a Zoom call with people that are the clients. And I'll tell you what, we'll just give you all of the details as far as the inspection and what to do. And so it's just a tremendous thing, the coaching. Billy and Becky wanted to do this to be a blessing to people. And that's the bottom line. It is for a blessing and get people in the game. The number one mistake for people is not getting in the game.
So true, Mike. That is so well said. Thank you so much. All right. So, Troy, I'm going to have you tackle this slide. Troy is totally our slide tackler
All
Yes, he
right.
is.
with graphs.
Let's get after the slide then. This looks like we're comparing the 10-year treasury market to the mortgage rates. And so it we can see how we got two different graphs here. You got the gold line and you got the gray bars. What we're looking at is how the mortgage rates trend after the 10-year treasury. A lot of people think that our rates are tied to the Fed. And if the Fed lowers rates, mortgage rates are going to go down. No, it's not that case at all. Mortgage rates are completely detached from the Fed funding rate. The Fed funding rate affects things like consumer debt, personal credit cards, things like that, but it doesn't affect the mortgage rates. That's the 10-year treasury market, which is a bond market. Now, typically when the bond market goes down, your mortgage rates go down. And if you look toward the far right of your graph there, you can see the bond market has been trending down and rates are trending down. Now, here's an interesting thing to look at. Notice the gap between the two lines there toward the right of your screen, the gray
That's
bar on the bottom, which is your 10-year treasury. I'm sorry, Karen?
I was like, that's interesting. Why is that? Because it's like very extended compared to previous years.
What it's kind of showing is the volatility we have in our economy caused a lot of by the $37 trillion in federal debt. That's causing a lot of people to ask questions, and it's caused this question in the bond market. And the mortgage companies, the mortgage banking industry is kind of looking at this and going, what's happening with our Fed rate? What's happening with our bond market? Why is the stock market still going up so high? And it's creating a little bit of uncertainty in the mortgage market, which is starting to settle out. That gap is starting to close there on the edge of your screen. You see the bond market up about 4 3/4 and the mortgage rates coming down to about 6. They had about a 2-point spread or a 2-point separation for a while, but now they're getting back closer to within about a 0.5 point. And we're going to see rates start to stabilize out. And they're going to stabilize out in the high 5s, high 6s, somewhere in there is what a lot of our analysts are predicting. And I can see as rates do stabilize out and normalize, 30-year fixed, owner-occupied homes in the high 5s to low 6s will become a pretty consistent thing.
Yeah.
That means investor homes in the mid to upper 6s and possibly in the very low 7s, which is still really good rate, especially when you consider where we've been in the last couple of years. Some of those investor loans are funded at 9 and 10%. So we get it down into the 6s and 7s. I think we're doing pretty good, right, Karen?
I totally agree. Just especially with some of the products like the DSCR, they're very investor friendly. And I think that investors or banks or private institutions, whoever, they're realizing that investors are a good risk and they want to provide the opportunity. And what I love about DSCR loans is they underwrite it. Your credit score does matter. So if you have an LLC, for example, you want the person with the best credit score to own, more than 20% of that LLC or have them kind of at the highest level
Yeah.
in your ownership of the LLC. So they take that, anyone that owns over, I think it's 20%, you guys correct me if I'm wrong, they'll pull or they'll look at their credit. So you have the ability to really push someone with a good credit score out there. They look at your cash, but they underwrite the property based on its ability to produce income. And so when you look at, for example, a vacation rental, we've got one of our Wealth Builders preferred providers, which is Frank Kahlo. He's got programs that they will analyze the potential earnings of a short-term rental or vacation rental. They'll look at a long-term rental and they're able to fund things and finance things based on the property, which is takes the pressure off your debt to income. At some point, anybody that owns a lot of properties, your debt to income from your personal level one income is going to max out. So the DSCR loans are super helpful and they're priced very, very competitively. This is a little off topic, but with the government shutdown, things are impacted. I've got an investor that I list properties for him and stage it, and it's just like in that sweet spot of military. It's right here in Colorado Springs, and the VA loans are shut down. And so it's an interesting time right now too. DSCRs aren't going to be affected because none of that runs through the government. But we're in a unique situation with this government shutdown that some of the pipelines or the pathways to get funding for people has been shut off. So I would just open this up. Troy, Frank, or Mike, you might know more about this, but can you just comment on how people are being impacted by the government shutdown with financing?
You bring up the VA loans, Karen, and that's so true. VA and FHA both, they're government underwritten loans. So with the government shutdown, there's nobody in those offices to do that underwriting. So that's going to shut out a lot of military buyers and a lot of first-time home buyers in this. But that, of course, creates opportunity as an investor to be able to come in and fill the gap. It's not that we're taking advantage of a situation, it's that we see opportunity. And as I don't know if you can see the really light gold letters on the bottom of this slide where it says wisdom anticipates, but faith acts. And we have been given a unique opportunity in this shutdown to step into those. Normally first-time home buyers would be a competitor for us, but if they can't get funding because the government shut down and there's no FHA loan, that means there's less competition, less people competing with our offers, and we're able to get more cash flowing rental properties.
Yeah, that's really a great point. We're going to show you some statistics too that talk about like that sweet spot. But you're right, people that have to sell quickly, we're helping them out by stepping in, but we analyze things different as an investor than we would if we were living in the property. And so we just got done with the next level conference, and one of the sessions I was just sharing that the way that you get like with an investor, it's not emotional. Okay. So what I mean by that is you run the numbers and you determine where it works, and we give you all the criteria that is going to help you make good decisions. And we'll cover that in the workshop. And definitely we go over everything with you in coaching. We run numbers with you. But based on that, you're coming with what works for you as an investor. And that really is a better position than somebody that needs a place to live or they fall in love with a home, because you're being logical and saying, look, based on the numbers, this is what works. And we've had incredible response from people when we take that approach. It's not that we're trying to undercut anybody. We're just running the numbers and we present what works. And as Troy mentioned, with FHA and VA shut down, that's a big chunk of the buyers out there. And I'm just telling you, that is definitely going to impact and is impacting the real estate market. Okay, so reading the rate cycle, mortgage rates follow treasury yields, which Troy did such a great job of explaining. The spread widened as we saw during 2003-20 in 2024, but we are expecting some easing there. And the high rate seasons that we just went through are for preparation. And we'll be sharing the opportunities for refis, which we've been talking about all along as well. All right, so this is the 30-year fixed mortgage rate average in the United States. And this is a pretty straightforward graph where you see here where the interest rates, I remember this, my dad was in banking and I was like 18 years old around this time, and I just he ran a savings and loan. He was one of the very few savings and loan that survived, because it was, he was just, my dad's just brilliant. But anyway, with this, you see like interest rates were up to 18%. It was absolutely crazy. So this just helps us get a little bit of the historical perspective to know that the interest rate environment that we are in today is very, very normal. All right. So Frank, will you take this? And this is about home price trends.
Prices have leveled off nationally since 2024. You're not seeing a lot of growth. You're not seeing a lot of dip. But again, remember, it's local. It's local. Every area is a little bit different. There are steady gains in the Midwest and Southeast and the coastal metros. Inventory growth has slowed major appreciation. So again, when you don't have a lot of inventory, things are going to supply and demand. But as we're gaining inventory and there's more inventory, it's going to level things out a little bit. And then low supply of quality listings, that keeps the market stable. Remember, you want to buy quality, not hype. There's a lot of hype in this industry, let me tell you, and that's what we try to cover in the coaching. I'm telling you, people just come in with these stories and it's like, well, that would be nice if it was true. But the best opportunities are moderately priced homes with solid rent ratios. And as Mike said, we have ways of figuring these things out, and we use some what should I say, some parameters. I won't go into those right now, but some parameters to figure out if you're going to do a buy and hold, exactly what things you should look for. If you're doing a rehab, what things you should look for. It's all in the numbers, folks, but it's not the numbers you want them to be. It's the numbers as they actually are.
That's so good, Frank. And just on this low supply of quality listings keeps the market stable. We just recently had a boots on the ground in Florida,
Yeah.
and Frank and Troy were there. And boy, we looked at some properties out there, and let me tell you, they were not the highest quality. So it's really an interesting time because in like your markets are all different. In the market that we're in, anything updated with a pool is just going for almost the highest I've ever seen, right? But then the ones that are out there, most of them are dated. They need a lot of work. They have not done updates. And that's what we would call the low quality listings. But in that is your opportunity to pick something up. And maybe you do something where you do some updates to bring it into that. So I'm going to be showing you a heat map a little bit later in this presentation so that you can see the difference in the local markets. But the key is you look for the opportunity in your market, study it. We help you do that. And then you can actually really understand the type of property you want to buy and maybe even some of the improvements that are going to bring it to that high level. All right, so this chart is median sales price of a home sold for the US. And Troy, can you explain the difference between median and average?
Absolutely, Karen, because they do get confused quite a bit. If you were to take, say, 10 homes and add up the prices together and divide it by 10, you're going to get the average. But what median does is median looks for the middle price range of those 10 homes. So the difference between median and average, median is more of a moving range or an indicator of market moving range, where average is a sampling of the subjects that were taken. That's probably not the clearest, but let's say median is exactly the line between the lowest and the highest sale that's happening in the marketplace. That median range gives us an idea of what's really moving in the market, and it's the best way to measure. And the reason the median range has been ticking up even in a slow market, because we've seen more higher end sales than we have lower end. What that means, you're going to hear me keep coming back to this. Sometimes your best long-term cash flowing properties are median priced and below homes, so they're on the lower end. I'm not saying to go into the ghetto and be a slumlord, don't misunderstand me here, but a lot of your best cash flowing properties are lower end. So if not many of the lower end prices are selling, then that's an opportunity for us and investors to get in there. I got a little off track on that one, Karen, but I couldn't help but slip that in there.
That's great information, all stuff that everybody needs to know. Thank you so much, Troy. And then this one is actually 50 years of housing growth. This is the FHFA index. And as you can see, going back to, I guess this would be maybe 1970, look at the increase that we've seen. This is the peak before the crash, it went down. But if you look at where we're at today, like these are very small movements. They might feel big, but they're small movements. And
And
what
still
this,
in an upward trajectory.
yeah, and still upward. And so here's just some like 3 points that help understand that slide. First of all, home prices are up 1,000%. you guys, since 1975. That's pretty amazing. There are some temporary dips, long-term trend upward, which Troy, you just said, and then faithful ownership builds generational increase. Mike, can you comment a bit about just like how important it is just to try to hang in there, hold on to properties through the ups and downs?
Well, yeah, you know, the stock market, if you lose your stock, if it crashes, you lose your stock. But I tell people, you know, they say, well, I'm so concerned about the housing market crash. I said, well, if you are a long-term investor, you still have a house, and you can go by that graph, even when it's going to dip, what happens after that? It's going to start going up. So if you just hang on to your house, Billy says, you know, 2 to 3 cycles, you're going to come out way ahead. And so it's just being faithful. And you know what? We're in this for the long haul. We have numbers that it's all about the numbers. It's going to cash flow. As long as cash flows, you can ride out the dips, and then you get to enjoy the appreciation many years later.
That's so good. And Bill Bronchek and Troy, you guys talk about like, oh, if I would have just hung on to some of these properties. Troy,
Oh,
can you
yeah.
comment on that?
Yeah, I'm sitting here thinking if I'd have just kept the very first house that I bought for my family and I for only $63,000 in 1994, where would I be now if I'd have just kept that house? I've done a lot of my real estate career buying, fixing, and selling, and I don't know how many I've done. I know I've done more than 100, probably close to 200 homes that we bought and flipped over time, and I've made a lot of money doing it. The problem with buying and selling is you're only as good as your last transaction, and that money disappears. If you hold it over time, that $63,000 house becomes 163,000, then a 263,000, then a 363,000, and pretty soon you're wealthier beyond your imagination, wealthier than you could have made yourself with a savings account. And the beautiful thing about it is, if it's a rental property, you've got a tenant in that that's paying you money every month. That's cash in your pocket every month in order for them to live in that house. And that rent's not dependent on whether the value goes up or down. That's still a rent because somebody needs a home. That means the tenant will move in, they'll pay that house off for you. Boy, if I'd have just kept 2% of the houses that I've owned in my life, I'd be sitting on a beach somewhere instead of on a Wealth Builders webinar tonight.
And the thing about that too is as the property appreciates, or as you do a cash out refi and you pull money out, none of that is taxable. It's,
Right.
you know, it's only taxable when you actually sell it. And we give you strategies like 1031s and other things too. So there is so much that is happening with real estate that is a benefit. This is really interesting. This is 2025 US home price growth forecasts. And, you know, obviously we can see that there is some, a little bit of variable in here. But I think the idea is that a lot of people from the media are like, oh my gosh, we're in a crash, things are going backwards. But when you look at 2025 and the projections by Moody's, JP Morgan, Wells Fargo, Goldman Sachs, and Zillow, everything is positive. And so don't buy the hype. You know, this is not a crash. It is moving forward despite what we hear in the news. And overall, all the big players are expecting that we're going to see even an increase in 2025.
Yeah.
All right, this is a really interesting graph too. This is an average sales price of new homes sold in the United States from 1965 to 2024. And maybe Frank, could you just comment a
Sure.
little bit about what we're seeing here?
You know, Bill Bronchick always says, you know, don't you wish you could buy a house now for what your parents paid for theirs? But this goes to show you where we've got some, especially here towards the end, 2022, there was low inventory. And so the prices
And
obviously
low
supply
interest rates.
and low interest rates too. And that combination drove those things up. So the pricing, and then you can see it's leveled out in 2023, 2024, and you know, pretty much in 2025. 2005, that must have been, I think that was when, I'll tell you when that was. Troy, back me up on this. This is when they had what we called liar loans.
Yes.
In other words, no doc loans. You could apply to a mortgage company and say, "Oh, I make $200,000 a year," and they'd sell you a house. And the common person that didn't know anything about real estate, it wasn't, I mean, maybe you had some friends, maybe you didn't, but that owned 4 or 5 houses, and that's great. Okay, and that's why the sales were up there. But two things were wrong. First of all, the mortgage companies had very loose terms. That isn't happening anymore. And the appraisers, they were in cahoots with the appraisers who would appraise them high. And all of a sudden, the whole thing tumbled down because the taxi driver that had 5 homes, all of a sudden, a couple of tenants wouldn't pay, their furnace went out, and then they couldn't pay their mortgages, and the whole thing went tumbling down. So,
That's so good. Thank you, Frank, for describing that and helping us understand it. Here's just some fun facts. I thought this was fascinating. In 1985, the median U.S. home cost $82,800, while the median household earned $23,620 annually. So it's a ratio of roughly 3.5 times the income. We have 4 criteria for you. One of them is to be between 2 and 4 times your median income when you purchase a property. But look at how the gap has widened. If you look at 1985 compared to 2025, the median annual household income has gone from 23,620 to 83,150, which is great. That's 252%. But look at how the US homes price has outpaced that. It's gone from 82,800 all the way up to 416,900, which is a 403% increase. So we've gone from something where the median American home is now 5 times the median annual household income. So there's a bit of a gap that is happening here, and that's definitely contributing to the market. Any of you guys want to comment on this? No,
I
I must
guess
be
not.
quiet.
I was
I
going to
guess
say, I
we
think
got
it's pretty
it.
self-explanatory.
All right, inventory, time on market, and rent trends. Troy, can you take us through this?
Absolutely. So active listings are up between 12 and 15% year over year. What that means is the number of available properties for sale has increased on average between 12 and 15%. Homes are sitting a little longer, but it's not gloom and doom long. Let me just kind of bring this. We are not heading for a market crash. In fact, statistics are still very positive toward a bit of a seller's market. In 2023, the average days on market was 33 days. That was the time that it took for a house to sell from the day it went for sale to the day it was sold. The average time was 33 days. Now it's 45 days. That's still relatively quick for a large ticket item like a home to sell. Rent growth has also been modest but stable at about 2.3% year over year. So rents are still increasing a little bit. Now, it's important to say that every market is different. We are talking tonight about the macro market, which is what's going on generally across the country. There are some areas where prices are still going up in double digit. There's other areas where prices are falling. So don't take what we're saying as what it means exactly for your market. But if you come to the workshop, we're going to start drilling in how you can understand what's going on in your market so that when you get back home, you can see the statistics that we're sharing for your own backyard and know what's happening in your local market.
That's really good. Thank you so much for that. This is a housing inventory, the active listing count in the United States. And this is just in line with the things we've been talking about. It was really tight in 2022. The interest rates were really low. But you can see as the interest rates went up, we're really seeing the inventory increase as well. And I would say, guys, it's definitely at a more normal level, maybe even still a little short. What do you guys think?
Yeah, I agree. I agree.
Yeah.
Down there in
Yes.
2022, that was like the perfect storm. Low rates, low inventory, big demand.
Yeah. Billy always says a normal market has about 6 months of supply.
Yeah,
And right now we're seeing about 5 to 6 months worth of supply in most markets. So we're really in a very normal, balanced market.
yeah,
Yeah, and we haven't been in it for a long time. It feels like the whole, the sky is falling, but actually it is much more normal, and that's definitely what we want to just express to you, that this is a great time to buy. Things are normal and there's an opportunity, because as interest rates go down, which I believe they will, it's going to start to escalate and go back up again. Mike, do you want to go over this historic median rentals?
Yes, this is a great graph because it just shows if you notice, there's not any major dips in this graph. And that's because rents they're just little by little, they stay increasing. And I did a little bit of research on this before we started. And I know that in like 2000, the median rent was $600. And so if you had 10 houses, Karen, that were doing that, and then you held on to them to 2025, that 1539, I looked it up. That's actually, I think the Zillow says that's a 1 bedroom, 1 bath, but a 3 bedroom, 2 bath is $2,000. Zillow says that. So my point is this: in 2000, if you had 10 houses for $600 rent and you kept them to 2025, that's going to be 2,000. Man, I'll tell you what, that is an increase it would just blow your doors off as far as being prosperous. You know what I mean?
Yes. Wow, that is really great perspective. Thank you so much, Mike. Okay, so there are real estate cycles, and there's a lot more information other than this, but this is very interesting to kind of know where we are at right now. And so Troy, will you take us through this?
Yeah, I think it's important to understand these cycles, these four main phases that we've got. You see them in every market. Recovery, which is where the market is coming up. Expansion, we see the prices increase. Hypersupply at the top of the market. And then recession, things are going down. It's always important to know where we're at. We're in a bit of a correction right now, which we would classify as recession. The next phase will be coming is recovery, where we'll begin to see an increase, and then will be expansion, where demand and prices and everything increase dramatically. I've seen this cycle repeat. I've been in real estate for about 30 years. I got started in 1994, which we had a glut of housing on the market, big foreclosures. We had the base realignment committee closing military bases around the country. We had all the supply left over from the savings and loan collapse that Karen mentioned earlier. And so you had more foreclosures. And what was interesting was rents still increased in that time, because people would rather pay rent than they would buy a house that might lose value, which meant great time to be a landlord. Here in 2025, we sit at the beginning of the expansion phase. Prices stabilizing, demand rising, opportunities forming. What a great time to own rents. Like Mike said, if you could have bought something back in 2000 that rented for 600 and today it rents for 2000, that's like a built-in pay raise, and you didn't have to do anything for it except take care of a piece of property and keep a tenant in it. Pretty easy thing. To see where we're at in the phase right now, you can begin to see how that opportunity for income today and increasing income and equity, which is wealth tomorrow, is sitting right here in front of you. Remember the regional differences we talked about? Real estate is a micro market. Your city could be different than the one 2 hours away. So really look at the regional stability, because there is differences. Midwest is stable. The Sun Belt, which is where I'm at here in Florida, is cooling off a bit. Florida, Texas, those were high demand states during the COVID shutdown. Now people are starting to move back and away, so it's cooling a little bit. And of course, the Northeast, we're seeing in a rebound, huge demand up in the New England area, really getting in there. Remember, the expansion phase is where wealth builders get positioned for long-term growth. So see the opportunity that we've got right here, right now. We don't procrastinate, we jump in and we get into the game, but we get into the game smart with the right education, right, Karen?
Absolutely. And that's what, we're doing with the Wealth Builders Conference, the workshop coming up. We're going to really focus on it. We've got a lot of new workshops that we've not had before. And we really want to help you to recognize the time that we are in and the opportunity that's there. History is a great teacher. And a lot of these things, you'll hear, all of us have been in real estate for a long time. You just heard Troy talk about over 30 years. Frank, I think you've been in it
Yeah,
probably about that amount of time too. Mike, you've
20 years.
a lot of time too. So you start to learn from history and you recognize what is happening. And then we don't miss the opportunity. Like 2008, 2010, everybody was scared, but the people that knew what was happening went in and bought. And that has made them, multimillionaires today. So that's what we're just trying to help you to understand is the times we're in and the opportunity that is there. All right, great. Mike, will you take us through what is working?
All right, small multifamily properties, 2 to 4 units. If it's over 4 units, it's a commercial property, and they're performing the strongest. Short-term rentals with unique design and experience outperform commodity listings. And I've got a couple of those, and I'm telling you, my short-term rentals are double the regular rents that I had before. Midwest and Sunbelt secondary markets, Alabama, Tennessee, Texas, and Florida are attracting investors. And again, that's micro, so it can be in your city as well. And then a strong return on investment in areas with job growth, universities or healthcare hubs. And so if you see things like healthcare facilities popping up near you, you can rest assured properties are going to start going up. And so here's the investor tip. Follow migration and employment trends, not the headlines. And so if Walmart's and Starbucks is building in your area, you're good to go.
That is so good. Thank you so much. All right, so is now a good time to buy? Frank, will you take us through this?
Actually, most markets, it's a good time to buy. You just need to know what you're doing, but you got to buy wisely. It's in the numbers, folks. We got lower competitions we talked about, and you have motivated sellers. Let's face it, there's more inventory and people are holding on to their properties and they have a reason they want to sell. Who knows what that is, but they're motivated and that's going to give you some opportunity. Inflation cooling has reduced the volatility of the market. And the key is cash flow over speculation. There are people that make a lot of money speculating, but they have deeper pockets than all of us combined. And so it really is a cash flow game, and you want to make sure that you're running positive cash flow. Investor tip, focus on assets that make sense at today's rates.
That's so good. Sorry, I moved that too quickly.
Appreciation is a bonus. Remember that. That's icing on the cake.
That's so good. This just really shows you how real estate is a local market. And so this is called a heat map. And so this is showing the different areas of the country, and it's going to reflect some of the things. Oh, apologize for that. That we just went over for the different areas. But when you look at this, like the big red areas, that is your hot markets. And remember the previous couple slides ago, I think Troy was going over that, just that the Northeast is hot, right? And then if you look at things that are, oh my goodness, that are in the blue, those are the cool areas, which means opportunity, light blue, purple, orange. And so you can just see pockets throughout the United States and know where they are sitting. And this is super helpful. So real estate is local. Red is a seller's market. Blue is a buyer's market. Local fundamentals matter more, much more than national headlines. And here's you might say the silver lining. Cooler markets show strong buyer opportunity. So it goes a little bit against the grain where a lot of people are like, oh my gosh, this market is cool. I need to back off. I'm scared. But actually, the investor mentality is looking at those cool markets, studying history, and saying, you know what? I think there might be an opportunity here. Hey guys, do you want to comment on that at all?
Good.
I mean, really just shows that you've got to take a look at the local market. I mean, that's no matter what the press says, no matter what the overall picture is, Look at, know your, whatever market you're investing in, you've got to know it. Okay. Bottom line. And it may not be the market that you live at.
That's so good. Thank you so much. All right, faith and wisdom. Wisdom means timing your moves strategically, not emotionally. Remember early on I was saying you get your price, you work your numbers, and you present your offer with what works for you. You're not emotionally attached, and if you don't get it, you just realize either they're going to come back around because the market is what it is and your numbers are what they are, or you just move on to the next one. Markets do fluctuate, but principles don't. So as we do stewardship, as we follow the guidelines that we teach in coaching that you'll learn about in the upcoming workshop, it creates stability. Avoid analysis paralysis. Oh my gosh, waiting for perfect condition costs growth. And we really have seen that, unfortunately some people just cannot make a decision to move forward. But you got to move forward. We do everything we can to help you to get the right numbers, but if in the end you just don't have the ability to actually move forward, you will never see your real estate dream come to pass. I think it's so cute to hear when Billy talks about the first time that he bought an investor property, his hand was shaking so much. He's like, I don't even know if I can sign this. So it doesn't mean that you won't have some hesitation, but part of what we do in the coaching program is we analyze deals with you. So when you go into it, you're not just depending on you. You've got this amazing group of advisors along with the facts of how to analyze things that helps you to move forward. So here's the investor takeaway. You don't need perfect timing. You just need perfect positioning. And that positioning really can be almost a state of our heart, but also just the openness to say, God, help me understand the times that I live in and help me know what to do. And so what we're telling you is based on historical perspectives, based on what we're seeing in the market. This is a time to buy and to get into the market. You want to do it smart. But if you've thought about getting into real estate the past few years and you just haven't done it, there is no reason to wait. Just get the good guidance and direction, and we want to help you make good decisions. All right, so with this is creative financing, and I think we're back to Mike, if you can take us through this.
All right. Explore creative options, seller credits, rate, buy downs, DSCR loans, as Karen was talking about. Boy, that is a major tool. It doesn't go as far as looking at what income that you have, but what the property will bring in. A 2-1 and a 3-2-1. Buy downs are common again in 2025. There's a major subdivision here in Pueblo that's brand spanking new, and the owner of that whole complex is offering 3.5% interest to buy down. So I'm telling you, there's things out there, there's deals out there, guys. And so we talked about FHA and VA loans remain powerful entry tools for new buyers, even though the government shut down. It won't be long before that pops back up as well. Investors using hybrid strategies, primary and short-term rental combos. And I tell you, when you go into the real estate workshop, there's some great teaching on this. And so we can't go through that in this short amount of time, but there's going to be some great teaching on this. Karen, you do vacation rentals better than just about anybody that you can find on the internet. And expect rates in the 6 to 7% range and short term. So if you looked at that graph, that's normal. That is normal. In 1967, my mom purchased her house at 7%. So that is the normal rate. And then refi opportunities are possible in 2026. I mean, the rates may go down, hopefully, to around the low 6, maybe upper 5s. And so we'll have to wait and see on that.
Yeah, that's so good. I know, like I mentioned, we're just looking at some of our properties right now because the DSCR loans have dropped so much. It's really been amazing. And I think it's going to continue to do that. I know that there's some things that President Trump is doing during this shutdown that's going to be helpful long term. But we just would really love to see those rates move down. that this get cleared up where the housing market is not being impacted by the shutdown so that we can keep things moving. I don't know how much tangible effect it has had on the market, but I would love to get you guys' thoughts. Like, Troy, do you think it's had a tangible slowdown on the market because this funding has stopped?
No, I don't think it's had that much impact at all. I think it's made a little bit of a blip. I'm sure there's some first-time home buyers out there that are extremely disappointed and they're kind of patiently waiting. But I'm confident that there's many loan originators out there that are still bundling packages, still doing everything they can to get it there. So when things reopen, they can push them through as quickly as possible. But overall, no, I think the impact on the housing market from this shutdown has been extremely minimal.
Okay,
Totally agree with Troy. Totally agree.
okay, that's good to hear because, it's just like, again, the media is hyping things. You really don't know what's impacted and what isn't impacted.
Yeah.
So
Keep
thank
in mind the media wants bad news because bad news is what gets you to stay tuned into them. If they told you good news, you turn it off and go out to dinner and go dancing and have a good time. But if they tell you bad news, you've got to stay glued to their channel. So don't buy what they're selling because all they're trying to do is get ratings.
That's so great, Troy. Thank you. Tell us what you really think. All right, creative deal structures. Let me tell you, in our advanced coaching, we really work through these creative deal structures with people. Frank, can you take us through that? You and Bill Broncheck are just so strong with this.
I could talk for a couple of hours on this one slide, but seller financing is resurging. They can't sell it conventionally, and so a lot of times what they may do is actually carry all of or part of the papers. Maybe they want some money down, but then you continue to pay them. And honestly, if they can afford to carry the papers, if you look at a 30-year amortization schedule, they're going to make a lot of money in the first 10 to 20 years in interest only, okay, just alone. Lease options and wrap mortgages. A real quick explanation. Lease option is where I might take a property that Mike owns and I lease it from him, but I release it to Karen for a little higher price, or I rent it out. Wrap mortgages, basically, I buy a house from Mike. The payment's $1,000 a month. It's at 4%, and I rent it to, or I actually sell it to Troy at 6 or 7%, and I mark up the price. So I'm making what we call as a spread, probably several $100s a month. And the best part is it's a good deal for the buyer, and you're not dealing with tenants anymore. You're dealing with buyers. So all of the midnight calls and all that stuff goes away. If you can't get into properties, partnerships are happening across investor groups. And we actually talk a little bit we talk a lot in the coaching program about partnerships and how to make sure you get the right partner. Builders are offering those 3 to 5% concessions on new inventory, along with, the interest buy downs. And just remember, every deal can be structured for win-win. Creativity builds cash flow, and I don't have time to go into it, but sometimes if you can give the seller what it is they need, you've got the startings of a good creative financing deal.
That's good. And again, we'll be covering so much of this in the upcoming real estate workshop, and we want to encourage you to be a part of that. We keep the numbers low with that workshop so you have access to us as coaches. Billy's going to be there. He's got a great teaching in mind. And also, we do something called speed coaching. We have fun with Deal No Deal. We've got a young investors group or a young entrepreneurs group. We have so many things that are happening. You do not want to miss it. And obviously, there's some things scripturally that we want to just agree with God. And these are some scriptures that really help us to understand that it's kind of our responsibility, maybe not kind of, it is our responsibility to increase in every area of our life with the promises of God. And these are some things, especially Luke 19:13. A lot of people say, well, the Lord's coming back soon, but God tells us, occupy till I come. And what that means is engage in the marketplace. buy, build, manage, and multiply until he returns. And so, I think we're close. We're in the third great awakening. And so God is going to quicken things, in my opinion, according to Amos. Like, this is a time that the reaper is going to overtake the sower. This is the time that God is quickening things because we're at hand here. This is our time to help build the kingdom in this third great awakening. Just some key lessons. Just remember, cycles are normal. Wisdom prospers in every season. Stewardship multiplies wealth over time. Local insights drives lasting success. And building wealth is a kingdom calling. The best time to buy real estate is when you're prepared, educated, and led by wisdom. So we've got a couple things that are going to help you with this. This event is happening next week, and you definitely want to be a part of it. And we've got a code that I'm sharing with you from just a recent conference where we'll give you $100 off either the in-person or the live stream. The best thing is to come in person. It is Friday night, all day Saturday and Sunday until 1, and it's an intensive natural and supernatural experience. What I mean by that is we definitely have got some wonderful things happening. We believe in the prophetic. We just invite the presence of God. We know that God's presence and us tuning into Him is going to open the door for us. And then we steward what God has for us through being a good steward of learning things in the natural. So here is the event. There's $100 off. And if you want to invest in real estate, this is the place for you to be, either live stream or in person. Whichever you attend, you'll be able to rewatch things for 3 weeks. And then if you're serious about this and you're like, I know that God's called me to get in the game, there's no better thing than the Wealth Builders Real Estate Coaching. We call you Wealth Builders Kingdom Real Estate Builders. There's programs out there that charge $50,000. We are part of a nonprofit. We keep the price as low as possible. But if you're serious about this and you want to get moving, this is for you. And you can schedule a free 30-minute consultation. All right, you guys. And so I'm just going to go ahead and stop share here. We're actually out of time. We've covered so much information, and we're going to be sending this replay out to our entire audience. And I do see just one question that I'm just going to run by you for us to answer. And this is from Sandrine. Welcome, Sandrine. And she says, how do you measure your cash flow when buying cash? How do you know you have the best deal? So that's a pretty broad question, but would one of you guys want to tackle that for us and answer, Sandrine?
Go ahead, Troy. I may have a different answer than yours.
All right. Sandrine, that's a great question. And it's really all about cash on cash return. Now, we do have a worksheet that we share in the coaching platform that Mike actually created that outlines all the income and all the expenses and helps to measure your cash on cash return. And we target a formula that understands if you were financing it with 25 to 30% down and you're getting at least 10% cash on cash return, then it's good. Now that return might go down if you pay all cash, but you've also eliminated your liability. So that could be a good scenario for your situation. But if you were part of the coaching program, we'd help review all that with you and help you make the best decision for what you're doing. Because you might not want to buy one property cash, you might want to buy 4 with leverage.
Yeah.
I might use the cash to capture a deal to make sure I get it, but I'm going to tell you, if it's possible, I'm going to refi out of that thing and I'm buy more properties. So
That's right.
That increases your cash on cash.
That's great. And Sandrine, this is a great question too, and we've answered you, but yeah, you can only attend half the conference in person, no problem. We will make that rewatch link available for you for 3 weeks. And so if you let us know that you can't be there on Sunday, we'll get you that live stream link there in person so you can watch a rest and live stream. And we know there's so much information that we cover, you have to have time to be able to review it. So that's something that I think Wealth Builders does really well because we know that you need time to absorb what we're sharing. Okay, so with that, this has been awesome, you guys. Again, we're going to share this video with our entire list. just so that people have an opportunity to learn about this and know the times that we are in. And Pastor Mike, would you pray us out tonight?
I sure will. Father, we are thankful for the knowledge that you are just giving your people, God. It's the will of God that none should perish. But God, you want us to understand, like Billy says, we need to understand and have the knowledge. And we thank you that you've given us the mind of Christ, that we can grow, that we can learn. And so I just bless the people that are watching this and thank you for their wisdom that's increasing in Jesus' name. Amen.
Amen. Thank you so much, Wealth Builders family. Thank you, amazing coaches. We love and appreciate you. Have an amazing rest of your evening.
Bye-bye.